In the past 12 months, house prices have fallen 16% in Sweden and yet risen 4% in the United States. Yet both housing markets have overvalued prices and rising interest rates. Why is there such a big difference between the two countries? In this video, we will look at where house prices are falling, which countries are most vulnerable to future prices, and why experts like Goldman Sachs are still predicting substantial falls in house prices around the world. After the surge in house prices during COVID, housing markets have really endured a bumpy ride, with higher interest rates, record unaffordability, high inflation and weak growth. The biggest drops have occurred in countries like New Zealand, Canada and Sweden. And while some have fallen quite substantially, others you could say are on edge. This shows the global level of house price to incomes and why countries such as Portugal and Netherlands are particularly vulnerable to house price falls. The US is an interesting case study because it has record levels of unaffordability and much higher interest rates. And yet so far, house prices have remained stubbornly high. We'll look at that more later. But the biggest crash so far is Sweden, with a 16% decline since their 2022 peak. The price collapse is a result of Sweden's dysfunctional property market. In the boom years, a shortage of rental properties and ultra-cheap credit caused house prices to rise 250% in just 20 years. And in the same time frame, the total value of mortgages rose by 460%, pushing household debt to over 200% of GDP. Given high debt levels, even a small rise in interest rates caused prices to fall rapidly. And it is a warning of how quickly a housing bubble can burst. Danske Bank in Sweden predicts a 25% fall, peak to trough, for Swedish house prices. New Zealand and Australia are both housing markets that saw record rises during the past decade. A shortage of new housing stock combined with ultra-low interest rates and a rising population meant house prices were squeezed higher. Back in 2020, the economists noted that New Zealand and Australia house prices were 40% overvalued. But then during COVID, they rose even more. At the peak of the boom, New Zealand house prices were 10 times median income. But then of course in 2022, like many other countries around the world, the unexpected high inflation and belated rise in interest rates caused a sharp decline in affordability. New Zealand was like the canary in the coal mine, a symbol of global unaffordability, and New Zealand house prices fell 13%. Yet the paradox is that despite this fall, house prices are still really very unaffordable. And it's a classic example of what is wrong with housing markets, especially in the Anglosphere, with very expensive house prices contributing to a very real cost of living crisis. But even the recent rise in interest rates have done little to reverse affordability levels. And this is a similar story in the United States, which has seen a record rise in house price to income ratios in the past decade. Between 2020 and October 22, US prices rose 38%. It was due to ultra-low interest rates, rising wealth, the COVID-induced dash for space, and rising prices also encouraging more investors to buy up property to let. But all these factors that underpinned rising house prices have now changed. The unaffordability combined with higher interest rates gives a familiar recipe for a potential house price crash. But despite many of these warning signs, the US housing market has been more resilient than you might expect, with prices only marginally declining in recent months. Now, on the positive side, you could say the hope is that inflation falling means the US may not need to raise interest rates much further, and that would be good news for the housing market. Nicole Bouchard, an economist at Zillow, claims a housing crash in the US is unlikely because a crash would require a substantial rise in mortgage defaults like 2008. The 2023 market is somewhat different to the housing market of 2006. Firstly, there's less exposure to subprime mortgages and those ballooning mortgage rates which cause so much devastation. Another difference is that in 2023, far more homeowners are on fixed rate mortgage deals, so quite a lot have been insulated from the recent rises. And also because households are on very low fixed rate deals, there's an obvious unwillingness to sell, and this is leading to a shortage of homes for sale. And it's this very low vacancy rate that is key for maintaining US house prices. And of course, inflation itself has propped up nominal house prices, with higher costs of home building pushing up prices and limiting new builds. Nevertheless, despite the ongoing shortage, some experts predict house prices in the US could fall up to 15%, especially in big cities, which saw the biggest rise in the past few years. One of the key issues is that over time, more will have to remortgage to higher interest rate costs. And first-time buyers coming onto the market are seeing a much less attractive proposition than a few years ago. But even a 15% fall in house prices wouldn't bring house price to income ratios down substantially, nor would it bring house prices to pre-COVID levels. Back in 2022, the Federal Reserve Bank of Dallas identified some warning signs of a bubble in the US housing market. These were rising house price to income ratios, but also pressure on real incomes and access to credit. Whilst house prices have only narrowly fallen, there are more homeowners who will increasingly be remortgaging to a higher rate. And with mortgage rates close to 7%, there's a lot more pain to come. And if the economy experiences a downturn or inflation remains more persistent than forecast, the pressure on the market could grow. Another factor is the PEW Trust reports that in the period 2020 to 21, there was an 80% rise in home sales, accounted for by investment firms. This is people buying a house to let it out or buy it to make capital gains. But in 2022, there was a very significant decline in private investment firms buying up property. And this was due to the rise in credit and also the likelihood that the market was nearing its peak. Housing has been an excellent investment since the Great Recession of 2008. But that has all changed since 2022. There's been a fall in speculative buying, and this is an important factor in reducing demand. After falling throughout 2022, Canadian house prices have actually somewhat recovered in 2023, with somewhat lower interest rates, an improving economy, and a continued shortage of housing pushing up prices. The Canadian government has indicated a willingness to intervene in the market to try and make prices more affordable. For example, the well-publicised ban on foreigners buying property. And in theory, this will reduce demand, and it could, in theory, lead to a bigger fall in prices. But the new legislation has proved more symbolic than actually changing the reality of the housing market. And it does show that, like many housing markets around the world, there's no easy solution to the long-term unaffordability problem. The UK is somewhat like the US, with very similar issues of very poor affordability and rising mortgage costs. And so far, demand has held up reasonably well, partly due to very high rents and also a limited number of properties coming onto the market. But the inflation data of last month was particularly a cause for concern, much worse than forecast yet again. And the result is the UK is now facing the prospect of even higher rates as the Bank of England try to catch up. So there's a lot of bad news to come for the UK housing market, which also has a very high house price to income ratio. And overall, the Anglosphere is really struggling with very high levels of unaffordability. And in theory, higher interest rates on top of this should cause a big fall in price. But at the same time, as many struggle with high rent and mortgage costs, there's still concern about whether there's enough supply. The FT, for example, report how the Anglosphere has fallen behind European countries in the number of homes per 1,000 residents. Countries like UK, US, Canada have fallen behind. The ratio of homes to people has stayed the same, whilst in Europe it's risen to 560. And this does make European housing markets more responsive. It's why you're seeing big falls in places like Sweden and Denmark, whereas at the moment the UK hasn't had the same price readjustment. And it matters because smaller families, ageing population and the rise in the number of households is placing this almost hidden increase in demand, and when supply gets held back, as it is in the US and the UK, it causes this mismatch of supply and demand, and it's a factor behind the resilience of really very high house prices. So the relative shortage, combined with rising wealth, rise of dual income households and investment demand, has kind of distorted long-term price to earning ratios, and that makes it more difficult to predict, because we cannot necessarily rely on past trends and expect prices to return to some post-war average. But at the same time, it's a mistake to say this explains all the difference. The reality is that a rise in mortgage payments from 2% to 7% really does reduce the attractiveness of buying a house, and this could lead to significant falls. So where is most vulnerable to falling prices? Europe has some of the most expensive house price to income ratios, especially Czech Republic, Netherlands and Germany. And also we've got the same issue of rising inflation and higher interest rates. Will the US and the UK markets turn? Well, it's a very interesting question, but any kind of more bad news and the market is so stretched that it would reduce affordability and prices could fall quite significantly. Well, I hope you've enjoyed this video, and there's lots more on the housing market. I usually make them about the UK, but you might be interested in this video on the problems with the UK housing market, which is really very relevant to similar countries like the US and Australia.